I have a special guest joining us on the show, Venugopal Garre of Berstein, heading the India operations. Venugopal, good afternoon. Thank you very much for your time. I remember reading a report from you just a couple of days back where you have questioned, in fact, analyzed whether this is the same kind of a situation we are in the markets which we saw in 2003, as a large section of the market is discussing that. Now, I would like to understand your thought process, but before that, I want to know what are the feedback you're gathering from your clients, from your overseas clients, because the way they are piling up in India, August saw its best monthly inflow from FIs in over 10 years.
Thanks, Ajay. So, on this FII inflow thing, I think to a large extent, if you see a part of the FII inflows in August is also to manage these fundraisings from the banks which have happened. So if I were to eliminate that part of the fundraising, it's still, of course, better than what we have seen in the last 1 or 2 months. But to a large extent, I would say this is more this worry about missing out on a potential 2Q or a 3Q recovery, which is probably driving in some degree of interest in India. And I think beyond this smaller earnings recovery and thoughts around that, I think two main things which probably are becoming thematic in nature, where we're getting a lot of discussions around this. One is the new economy side of things in India, where you are seeing some advantages of global liquidity creeping in, where we are seeing investments in India. The second one, of course, is about Make in India itself. Now, there is a broad emerging thought process that this could potentially be a relevant game changer for India. It's a different thing where we don't fully agree with that. But I think a lot of these things is potentially driving some degree of interest internationally into India. But I would still adjust out for these fundraisings from banks like ICICI, Axis, etc. when I look at the FII data.
Right. Venugopal, let's come back to that very nice report which you had published recently. How would you rate the cycle for Indian markets given the circumstances we are in next 3 to 5 years? Is it justified to expect a kind of a case for a multi-year upward move for the markets? If yes, how strong is that case?
The interesting thing is we sort of brought in this discussion in our report, which was more like, is FY21 equal to FY03? So a host of things we highlighted there where it was more about macro similarities, especially things around GDP or interest rates or inflation, banking NPA cycle, as well as the all-round challenges on consumption, as well as CAPEX that you see at this juncture. I call it as convergence of weakness in CAPEX as well as consumption. So, I mean, look, the similarities don't stop at this. It's also about reforms, which quite a bit of that was done from 97 to 2003. So there is a backdrop of reforms even this time around and a backdrop of a weak economy. But I think there is one main difference that we need to look at is that this time around, a lot of reforms which were announced were primarily not executed properly. To give a context here, just to explain why this is not about announcing new reforms, it's about executing something which has been announced well, is what is going to be a driver. So things, for example, look at things like the last couple of years where we started with this DISCOM revival scheme, which was Uday, and we all know what happened. Eventually we had to pull in another $15 billion recently, to fund the DISCOMs. We have this Bharatmala scheme where the markets got really excited, which was an entire construction for roads across the country that somewhere down the line, seems to have lost as a trend. And then you had the smart cities, housing for all scheme, and the industrial corridors that we were trying to push. So look, if you look through the last 4 or 5 years, there has been a host of announcements and themes which emerged, which excited the markets. And at this juncture, it is the revamped Make in India scheme. So this is also an old scheme which has been revamped at this juncture. So the problem that I see is, one is if the execution is weaker, a lot of these things happen eventually, but over a longer period of time. So you will probably manage to meet and execute all these things in 10 years rather than in 5 years. But for cycles to get formed, you need to be doing that very quickly. That's how cycles get created. The second missing piece which I see is on the private sector participation itself. Private sector probably realizes it's not really easy to make money outside of what they are doing, especially the flow of capital we saw from the private traditional industrial sector into other areas like infrastructure. But you don't have resource availability, which is as easy at this juncture. And more importantly, return thresholds are significantly reduced. So that's where you would also miss this sort of a missing piece on the diversion of flows of capital into areas where we need investments. So all in, I would probably, I mean, this is a fairly large debate, but all in, I would probably argue that we are more looking at a recovery of the lows, which is for a relatively better second half and for a better FY22 compared to FY21, rather than calling us at a stage where we are at, let's say, a potential for 7 to 9% GDP growth rate over the next 3-4 years. Yes, it can happen if you execute things well, but I don't see at this juncture a reason to believe anything much will change.
Right. Venugopal, right now what has really surprised many on the street is the speed at which the banking sector has come back and there is eagerness to buy. Probably some amount of assurance also coming in the speed at which some of the big ones have been able to raise capital. Banking sector performance or the way it does is very critical for the overall market, how it does. What are your thoughts on how banking prospects are looking, especially the 4-5 clutch of large private sector banks and say the top couple PSUs? How are they likely to negotiate the terrain which looks very patchy right now? Because it will be very intertwined with the road the recovery in the economy actually takes, isn't it?
No, that's right. I mean, honestly, it's a very macro-linked sector, and you've seen a lot of challenges. Even in the backdrop, this is not really a new challenge which emerged at this juncture. I think it's been a challenge which has been ongoing for a while for the banking system. And if at all, I would say that there was some form of a backstop which the government did provide, the so-called stimulus 1.0, especially for the SMEs. So at least one part of that was taken care of. The second part I would probably say is, the fundraisings which were primarily a concern for the market about, let's say, 1.5 months back. And that to a large extent has also probably happened and fairly successfully happened. So at least these frontline banks have enough capital buffers now to manage any uncertainty, going forward in the economy. The missing piece I would say it still would be growth. We're not really calling for a very relevant credit growth at all this year. So that's probably the missing piece that has more economic impacts rather than how people look at banks, because I don't think people are in fact looking at banks from an investment point of view, thinking that there's going to be a tremendous change in growth rates from here. It was purely a situation where you had a lot of defensive sectors doing well in the in the broader context of the markets, with also the viewpoint that macro will recover. So if this macro recovery viewpoint holds good, then it is unlikely that the banks will not wholeheartedly participate. The only difference I would say is that I think if you look at where these top frontline banks are, I mean, apart from one or two, maybe a Kotak or HDFC, the rest of them are still substantially below where they were in January. So I don't think this rally that you saw in the last 1-2 weeks could be even called as a meaningful rally. So what I mean by this is, as you move into the next 3 or 4 months, when you have a clearer sense of where NPA is heading into, you could probably see more room for returns from these larger banks.
Fair point, Venugopal. So, from here on, what is the case you're making in terms of the portfolio construction? What are some of the bets which you think would be the leaders of this cycle, however protracted it might be, if one were to take a 3 to 5 year view?
Yeah. So look, honestly, given the backdrop of a view that this is not going to be a smooth cycle over the next 3 or 5 years, we are not really, taking a large sectoral bet on a consistent basis. The way we are approaching this is the only main area where we see probably some consistency of growth coming in is especially the new economy plays. Now, when I say new economy plays, there are probably 1 or 2 larger ones which especially companies like Reliance, which have managed to, garner fairly large funding and have a potential business model in place. Of course, they've also been a driver for the last couple of months of market returns. But as far as sustenance of a theme is concerned, probably this is one area where I see there is still room for sustenance of a theme. See, the rest of it, primarily, where we still believe that banking sector will come back, even in a context of a 5% GDP growth rate. So you'll probably see that also emerging, especially the frontline banks, more so from a consolidation point of view as a theme. On a smaller scale, we do like discretionary, smaller value discretionary, things like electricals and durables, which I think is also tied up with the real estate cycle where things look bad at this juncture, but probably will recover off the low. That's a cyclical bet rather than anything else. So these are 2 or 3 areas that I'll probably argue, where there is still room for sustained value creation over a 3 to 5 year. The rest of them, I think we're going to take calls largely from a point of view of, at any given point of time, which sector offers you an earnings momentum. One last thing, of course, is in the broader scheme of things, 2 other main areas of debate which has emerged about sustenance. This is nothing to do with the bull cycle. Is one about IT itself, where we have been a bit vocally positive, more on the opportunities that are probably going to emerge in this new age, especially the digital age, where we think IT companies are in a much better situation going forward to get back to a respectable growth and without margins getting impacted too much. So this is an area which is a part of a portfolio. I think it's going to be there for a while, in the sense of 3 to 5 years sort of a view. And lastly, the pharma sort of a thing where it looks like emerging as a sector which could have some bit of a cyclical leg up for the next couple of years. But this is not really in the similar light as a new economy play. So the initial ones which I mentioned are probably ones which are more sustained, in terms of how I would look at the next 3 to 5 years.
In fact, that point which you made, that new economy, companies and stocks and Reliance is emerging like that. And now after sealing this deal with Future Group, the way its footprint on the retail side actually expands a lot. And of course, it is backward integrated with their technology play. Did you manage to take a look at this deal, which was seen coming for some time now, but now has been sealed into a win-win format for both? And of course, the lenders. Did you manage to see any view there?
Okay, so I mean, the broader view is I think it is in some. See, we were not really. See, this was an expected deal in some way, So wasn't really surprised when it came in over the weekend. So it's been in the news for a while that something like this will happen. And more importantly, the commentary from management even earlier that the next area of focus for them is how they're going to basically push towards retail. So it fits in their scheme of things and what they had announced. And of course, the next thing is only about how they monetize the retail portfolio. So we don't know whether it's going to be very similar to the new economy, sort of investments they've got, but this is also the next thing that you're going to hear. So for Reliance, the next leg up is primarily around this. And I think it is primarily for them, a combination of both old economy and new economy that they're trying to integrate. And I think they're probably in the best position to, integrate those and especially the kind of investments which are required to deliver these. So, I mean, they're in a consolidation mode at this juncture in the retail side, which is probably a very positive thing in our view for the stock.
Venugopal, just a word on the broader markets. How are you analyzing the valuations of, say, the top 100 stocks in the market versus the rest? Do you see value emerging in the broader markets, and have you started looking deeper into the companies which have managed to wither the storm or are fighting very carefully, are emerging? Any views in the mid caps?
Yeah, so Ajay, I had this thought process. I'll just quickly put down the valuation side of things. If you look at large, mid, and small cap, which is the indices which are there, the universe of 500 stocks, as I call it as, what you've actually seen is YTD, these 3 indices have broadly returned a very similar thing, maybe mid single digit sort of a decline. But off the lows, you've seen small caps actually do well, which is off the lows in March. And that's probably because of the fact that they also got hurt before COVID a bit more. But put in context from a valuations point of view, mid caps now traded a slight premium to large caps, while small caps are at some discount, but the discount with large caps is narrowed. But we are still nowhere close to the peak valuation gap which mid used to have with large cap, which is probably about 3 years back. So if you want to take that light, you'll probably say that, look, there is a large room for SMID to actually outperform large caps going forward. But our approach was slightly different, because we're in a very strange situation where we are in the economy at this juncture, right? So, and of course, it's a strange situation because there is opportunity as well as uncertainty. So in that context, the last couple of months of rally, one common theme came out. It was primarily sectoral themes which were driving the market, not necessarily about large cap versus small cap. So if you see the sectors which did well in SMID were almost the same as the ones which did in large cap, which is your staples, IT, chemicals, things like those. If at all SMID offered you some extra opportunities on the so-called Make in India theme, which were stocks not available in large cap. So I call it as stage one of the cycle, where you have themes which drive rather than size of the stock. The second stage basically is where you see laggards do well, which is your financials, industrials, construction. But remember that when laggards start doing well, mid laggards are typically higher risk than large cap laggards, because the first leg, as I mentioned, are companies in general with great balance sheets. The second leg is not necessarily the case. So I don't know at this juncture whether in the second leg you have a synchronous recovery in the laggards for large cap and small cap. Possibly there might be some lag. And then of course the third leg, which is your all about SMID outperforming large caps. I think that is a euphoric phase. We see that from time to time. I'm not modeling that for the next 6 months, but probably something which might happen if macro genuinely rebounds strongly. This has nothing to do with bull cycle. It's just about the strong rebound in macro, which possibly is being penciled for next year. So that's the way I approach, SMID cap. Look, having said all this, there will always be these individual stocks here and there, within categories of SMID or large cap where you would still buy irrespective of sectoral context. I'll put that discussion aside.
Right. All right, Venugopal, we'll let you go on that one. Thanks so much for joining us. Always wonderful to have your thoughts on the investing environment. That was a Berstein view as far as the markets are concerned and how they feel things could pan out in the Indian investing universe.